Hello, everybody. In this lecture, I'd like to talk to you about kind of the nitty-gritty of the valuation practice, and in particular about the final product that every evaluator is expected to deliver, right? Business valuation, of course, has multitude of needs. Sometimes you do evaluation for internal purposes. For example, if you work for an investment bank and you want to, try to value out a prospective acquisition for fairness opinions and so on. We've talked a lot about that, right? But in this lecture, I want to focus on the notion where somebody is an expert who was specifically hired to deliver an opinion on the value of the company. When does that happen? Well, it happens in a couple of cases. For the most common cases, when there's some sort of a dispute over a value of a particular firm. So in other words, there's a lawsuit going on. So for example, let's say there was a merger or an acquisition transaction, and one of the shareholders, perhaps a dissenting shareholder, feels that the price that they were given for their stock was too low, right? So they can go ahead and sue if it's in court and say, look, this acquisition didn't deliver me the fair value of the stock, and I'm entitled to additional compensation. That'll be one example. Another example might be where, let's say, which is very common in inheritance type of cases, as you know, if it's a sufficiently wealthy estate, you have to pay tax on it, right? And in the United States, over $10 million, if the value of the estate is over $10 million, you have to pay estate tax. The descendants of the estate have to pay tax on it. And obviously, there's a huge incentive for the descendants of the estate to say, well, this estate is not worth, it's worth ideally less than 10 million, but just to report the lowest value possible, because the value of the tax is based on, the amount of the tax is based on the value of the estate. It's called ad valorem tax, right? So in this particular example, you have two opposing sides. One is the IRS that has an incentive to have the highest possible value so they can collect highest possible tax. On the other side, there's the descendants who don't want to pay the tax, so they have an incentive to undervalue the estate. And the list could go on and on. I mean, you can talk about possibly damaged cases where the company value was permanently damaged and so on. The bottom line is, in this kind of a potentially adversarial situation, an expert is hired by both sides, and they have to produce a report that essentially values an asset, whether that's a company, whether that's something else, an estate, and so on, right? So the question becomes, what do they need to do in this process? And the deliverable is the valuation report, and they're typically hired by a lawyer representing whatever side they work for, the lawyer works for. And that report then is entered into evidence, and the witness, the expert could be deposed, it could be cross-examined, and so on. And ultimately, the judge and maybe the jury decide on what the right number is, right? Okay. So this chapter 17 of Trugman talks about this valuation reports. So what is the objective of the valuation report? Valuation report is the ultimate work product of the valuation expert. The nature of those reports varies depending on the type of the assignment, right? So in other words, unlike an audit report, for example, where the format of the audit report is preset essentially by the auditing standards, there's a bit of discretion that the valuation the formatting kind of entails. But there are certain standards that of expectations of valuation reports and what should be in them depending on the type of valuation report expected. So, and that's why it says the types of valuation reports depend on the needs of the clients and the cost of the client is willing to incur. The longer, the more expensive. So here, where do we look for guidance? Trugman's book was written as part of the American Institute of CPAs, AICPA, they now call themselves slightly something else, but the Regional American Institute of CPAs Business Valuation Program, right? They have a credential called ABV, Accredited in Business Valuation, which is specifically targeted towards CPA, Certified Public Accountants. So you become a CPA first, and many CPAs do valuation work as part of their practice, either in the context of maybe valuation of intangibles or maybe gifts and estates, what have you. So therefore, there is a perceived need for CPAs to have a formalized valuation credentials. There's other credentials. So for example, for non-CPAs from American Society of Appraisals and so on, appraisers. The focus of Trugman books is on SSVS, Statement of Standards Valuation Services #1, which is targeted for CPAs or valuation practitioners. But at the end of the day, like, it doesn't really matter as much because he actually compares the Standard 10 Business Appraisal Reporting for American Society of Appraisers. And they kind of say the same thing, right? But there's some maybe very, very tiny differences. So it's helpful to use the SSVS1 as kind of the guide here. All right. So SSVS1 and AICPA put out a fact sheet, which is kind of like Cliff Note summary on it. So what is its purpose? The standard is intended to provide AICPA members guidelines for developing estimates of value and reporting the results, right? Which is what we talked about. And it developed the standards to improve consistency and quality of practice among members who perform engagement to estimate values. In other words, as you can see, just like any profession, there's a lot of discretion involved. In particular, in something like valuation, where if you remember revenue ruling, IRS revenue ruling that was studied in the beginning of the course talks about it being a prophecy, right? So yes, there's a lot of kind of guessing here and opinion here, but you need some degree of uniformity, right? We're not talking about being right, but about being reasonable. So that's the goal of this standard. So it applies to two types of engagements, valuation engagements and calculation engagements. So for valuation engagements, two types of written reports are permitted: detailed reports or summary reports. So first of all, what is the difference between valuation and calculation? Valuation is basically when a report is asked when you have to provide the actual assessment of value, right? A calculation is something much more, so valuation report is when you need to provide a valuation and need to justify it, right? What is this company worth? What is this estate worth, in my opinion? A calculation is something more mechanical. You're asked to calculate some very specific things. Now, maybe it's a certain calculation of a value of a certain asset, but much more mechanical and circumscribed. And for that, you have to issue a calculation report. So maybe an analogy here might be like in the audit world, we have audit reports on the audit of the financial statements as a whole. And then you also have agreed upon procedure engagements. They're just specific kind of carve-outs of things that you may be asked to do. Maybe part of an audit, maybe like one financial statement, what have you. So that would be like an analogy for valuation and calculation engagements. Now, that's a bad analogy in a way because valuation and calculation engagements are not assurance engagements. Valuation analysts do not provide any sort of assurance. Audit and similar engagements could be assurance engagements. So, and then it talks about when does it not apply? When the value of a subject interest is provided to the member by the client or third party and the member does not apply, valuation approaches and methods does not report the value of the subject interest, right? So you're not doing valuation, you're not using the common valuation techniques, and you don't issue valuation report in accordance with SSVS1. When the member estimates a value part of an audit, review, or compilation engagement. Now, when the valuation is done as part of an audit or other accounting services procedures, and a separate set of standards that apply. That would be standards, either auditing standards, right? And we'll talk about that in a minute, or standards of statements of standards accounting review services. In that context, valuation is basically an accounting or audit procedure. You are doing it in the context of that engagement. So therefore, valuation, it's not a valuation report, it's more just within the context of the broader engagement. Or when value engagements are exclusively for the purpose of determining economic damages, unless your determination is used to estimate value of the subject of interest. So if you are in the court lawsuit, if you're in a lawsuit, the part of the lawsuit where, let's say, somebody stole trade secret or something like that, and you're trying to ascertain damages as an expert, then that's not applicable, even though it's something very similar. Mechanical computations do not rise to the level of engagement to estimate value, where the member does not apply valuation approaches or methods to use professional judgment. So again, key is here, professional judgment. You don't use common approaches. You don't debate. You don't engage. This is just more mechanical. So then this report doesn't apply. So now, if you just as kind of an aside, because some of you may end up working for accounting firms in context of audits, if evaluation is required, as let's say to value goodwill or an intangible asset, or so then that's where, let's say, for public companies, PCAOB guidance on becomes the guiding rule. So there's a guidance on accounting audits of estimates of fair value. I provide a link here. And also, you are then considered an audit specialist. Evaluator is considered an audit specialist, so therefore, auditing rules for public companies, at least for the PCAOB, provides the special guidance on supervision of specialists. Similar guidance exists for non-public audits of non-public companies through ACPA US GAS. So in many ways, PCAOB guidance is just very similar guidance, just kind of more sophisticated and a bit improved. All right, so that's beyond the scope of this class. I'm basically giving this to you as an FYI so that you're aware of the contextual differences. All right, so here's some of the components or key relevant considerations of SSVS1. So in determining, this is straight from the standard, in determining whether he or she can reasonably expect to complete evaluation engagement with professional competence, right? The evaluation analyst should consider at minimum the following: subject, entity, its industry. So what does that mean? Well, it means that you basically have to understand the economics and of the company or the entity, not just the microeconomics surrounding the firm itself that you're trying to value, but also sort of macroeconomic conditions that either have preceded this valuation engagement and expected macroeconomic conditions. So essentially what is being expected is reasonably good financial statement analysis in the context of overall economic environment. Subject interest, I mean, what exactly are you valuing? How many shares of stock? Is it minority interest? Is it the control interest? What are you trying to value? Is it the whole company? And as of what date? So valuation date here is critical, right? Because obviously you want to kind of have the cutoff point at which the value is estimated, and particularly it becomes critical in, say, in calculations of, an assessment of tax. The tax is assessed at the time of death, right? So not like 2 years later, let's say state tax. So this valuation date is very important. And it's also important because, that affects your consideration of what information you're going to use as part of your valuation engagement, the evaluation report. Purpose of the valuation engagement, what is it done for, right? Is it for tax litigation? Is it for, kind of just, maybe a shareholder lawsuit in the context of M&A? Is it for something else? Just you're trying to, decide whether you want to buy this company or not. It's a fairness opinion. Assumptions and limiting conditions, right? That's the key point, right? So you want to make sure that it's very clearly understood what you have assumed, right? Because that drives your judgments and your conclusions. Now, of course, that's the weakest point of any valuation report, that is the door which the opposing valuation expert will use to criticize your conclusions, right? That's the whole debate about this, right? About essentially the debates over valuations are typically focused in this area. What did you assume that we can say, oh, we don't agree with it, this is the wrong assumption? What methodology did you use? Which should be a different methodology. Applicable standard of value. What are you trying to value? Actually, this is more of a legal concept. We talked about standards of value being fair market value, fair value, and that's driven oftentimes by the state law that, if it's a state litigation, that's most of the time is the case in this kinds of matters. What standard of value to use, or if it's an IRS, what standard of values, and your lawyer will tell you, right? And whether applicable discounts, let's say discounts you do like marketability could be used and so on, right? So that's very important here, what standard of value you use. Who are the intended users and the restrictions in use of the report. So by the way, Trugman in his text says that it's very critical to, in any case, restrict the use of the report specifically for people that you work for, right? You don't want this kind of floating around and then potentially being used against you or be misused, right? It's a very, very particular client for very particular litigation. and then any sort of governmental regulations that may apply. All right. Other considerations, you need to understand the nature and risks of valuation services to be provided and the expectations of the client. Valuation analyst should consider the matters in paragraph 12 in addition to the meaning of the following: the proposed terms of valuation engagement, what are you delivering, when are you going to deliver it, the identity of the client, who the client is, why they're asking, the nature of interest and ownership rights, whether it's control or not, right? That makes kind of sense because we talked about marketability, control discounts, and so on. Procedural requirements of valuation engagement to the extent of any to which procedures will be limited by either the client or circumstances beyond the client's or the valuation control. So this one is more about, you don't want this report to be misused somehow outside of what you're doing. You're doing it for a particular purpose. That's why it's important to be restricted. And that's why the use and limitations of this report and conclusions of calculated value are important. Any obligations to update this valuation? Are you required to, again, that's where the valuation date becomes important. Are you required to, update due to any sort of new circumstances as of what date and so on? The valuation analyst should establish an understanding with the client, preferably in writing, right? You need to have a contract, you have to have an engagement letter regarding the engagement to be performed. If the understanding is oral, the valuation analyst should document the understanding by appropriate memoranda and notations of work papers. You should not have oral contracts in general, things like that. You should have a written contract. Trugman in chapter 3 gives you an example, a template for an engagement letter. So if you always have a written contract, all have stuff in writing. Even you're allowed to have oral contracts are just a recipe for a disaster later on. Just don't do that. Regardless of whether the understanding is written or oral, the valuation should modify the understanding if she encounters circumstances during the engagement to make appropriate to modify that understanding. And here's the reason why you shouldn't have oral contracts to begin with. Because in the written contract, you actually have to, if you have a good contract, good engagement letter, you have to stipulate circumstances that, let's say, it ends up being you're doing a lot more work than you expected because the client, just like in any audit, you see that they didn't provide you the information, it was a lot more complicated. It kind of allows you, let's say, so look, I expected to do 20 hours here, but because you didn't give me the data, or the data was a lot more complicated, I spent 100 hours, you have to pay me more. So kind of stipulate in a written contract contingencies and obligations of the client to give you information and so on. And what happens if they don't, right? The understanding should include the minimum nature, purpose, and objective of valuation engagement, the client's responsibilities. That's like to give you stuff, to give you information, to be helpful to you. Valuation analyst's responsibility is to deliver the report, by which date, to be willing to testify in a deposition or in cross-examination in court, should the need arise. The applicable assumptions and limiting conditions, the type of report to be issued, and we talked about the types of the reports being either full report or summary report, and the standard of value, fair market value, fair value, and so on, or intrinsic value or investment value. All right, so we'll focus so far on SSVS 1. Here's, if you're not a CPA and you want to be subject to the Uniform Standards of Professional Appraisal Practice, use PAP. For example, in particular, to become real property appraiser in the United States, appraisers must take the course. And so these standards, they kind of define how you produce appraisals for non-accountants. So if you're in that category, and if you're not a member of the ACPA, I suggest you consult them and spend the money to buy them. Here's some, I don't have access to them because they're quite expensive. And Trugman discusses the relative differences. But here's a summary of some of the important aspects of the compliant US PAP report. Identify the client, the recipients of the report. Same thing is available in the valuation services standards. State the purpose of business valuation. We just saw that again. Discuss what is being valued, such as business assets, including your analysis. State the valuations down to control interest basis. It's almost exactly the same thing we saw with SSVS. So there's no great differences. Valuation premise, for example, that's a standard of value essentially. Affects the standard of value being used. Is it in use? Is it best use? Is in best market and so on. So a very similar standard to what we saw with SSVS1. You need to discuss the three valuation approaches, which we talked about: the market, income, and replacement cost. And you need to discuss them, explain them. That all is all present in the that's all present in the SSVS1. You see all exact same things for ABV standards. Some notes from Trugman on USPAP standards. Conclusion reached should be communicated in a manner that's not misleading. Well, surprise, surprise. Report should be clearly and accurately presented. It should also contain information to allow the reader to properly understand the contents, the source of information used by valuation analysts to draw certain conclusions, and the basis for conclusions reached. Valuation analysts should also disclose any unusual assumption or limiting condition. So that also, so it's pretty much the same thing. There's no real great differences. The definition of value must be in the report, right? So either way, kind of the two frameworks are almost identical. Certain assumptions and the report should contain assumptions covering the entire report. So like big, broad assumptions. For example, that the information provided is valid without independent verification. That's a key assumption because this is not, evaluators are not auditors. We essentially rely on the client's representation that whatever they have us do, whatever information provided us is truthful, and we're operating on that basis. It should be put essentially in as a disclaimer, right? So it's a liability protection technique. So should there be no confusion. This is not an assurance engagement. It's just basically a consulting engagement where you, in reliance what the client says, you are providing an assessment. So certain assumptions, limiting conditions are standard for every report. They should be included in an engagement letter, which Trugman provides in a template of which it provides in chapter 3. So this is straight from the teaching notes that Trugman gives you. So let's discuss some of this. Assumptions, limited conditions. The conclusions of value arrived herein is valid only for the stated purpose as of the date of valuation, right? So in other words, this is kind of a disclaimer that you have to put in, essentially so that somebody wouldn't take this report and kind of try to use it in a different environment, different time, in a different context, and then kind of abuse that. And then you would be on the hook for that misuse. So, right, you have to be very clear that this is just for this particular case, just because circumstances change, information changes, dates change. You cannot, different context, different valuation needs to be performed. So the other thing also, financial statements and other related information provided by the business or its representatives in the course of this engagement has been accepted without any verification as a full and correctly reflecting the enterprise's business conditions and operating results. So essentially saying, okay, client gave me financial statements. I'm accepting them to be true. I'm assuming them to be true. I'm not an auditor. If this is fraud, it's client's responsibility, right? I'm just simply basically, providing my opinion of value given the information that was given. So we have not audited, reviewed, or compiled the financial information provided to us, and accordingly we express no audit opinion or any other form of assurance for this information. Again, this is a litigation protection clause for the valuator because they could be sued if they don't put it in. Somebody could say, look, I just got confused when I saw this valuation report. I really thought it was an audit. Kind of an absurd argument because an audit looks very different. But if you don't say it, then you have to go prove yourself otherwise. Right? You have to go to court and testify and this and that. You put it in the report right there. Nobody could claim that they misunderstood. Public information, industry, and statistical information have been obtained from sources believed to be reliable. Right? So we all have to rely when we do those reports on, some Capital IQ, on Mergent, on IBIS World, what have you. Right? We assume that they're actually, don't give us wrong information, right? Maybe they do, but we don't have the time or effort to go and verify that. They're reputable sources, they're widely accepted sources. So we rely on that, right? So, however, we make no representation as to the accuracy and completeness of such information and perform no procedures to corroborate the information. Again, if somebody later on could say, if we don't say that, well, if Capital IQ got your own data, which actually could happen, and it has happened before, where Standard & Poor's had mistakes in that data. Well, you have a responsibility to go look at that. And you didn't do that. Well, no, we don't. That's kind of unreasonable, don't you think? Well, no, here we say we don't have the responsibility, right? Should we become aware that there was a problem? We have a responsibility to update our estimates, maybe, right? But we have no responsibility in the routine course of business to go and verify this information. Because with Trust, Capital IQ is one of the top providers of financial information. That's what they're saying is not wrong, or not materially wrong. But in the meantime, we also don't represent to anyone else that we did anything to verify that. So that protects us. So importantly, in the report, you should disclose any source of information that you use, whether it's databases and so on, that affected the conclusion of value. Should be your discussion of those independent sources of information should be sufficient for an independent reviewer to review the sources and not include the relevant source of information. So somebody is to be able to go and essentially redo your work. So that includes, for example, things like computer code, right, that you may be asked to provide. So it's very important if you use Python or Stata or what have you, or even Excel, that it's very clearly documented how you did things, right? Somebody has to be able to reperform it. So here documentation is a good documentation is highly advisable with lots of comments, because this stuff may come up years later. Do you remember what you did 5 years ago on that report? I don't know. It depends on the statute of limitations when it could come up. So as you work on these things, it's very important to just have a very good, clean, self-explanatory record of work, right? So with lots of comments, very well organized. So if you need to turn to it and, let's say, turn it into a judge 5 years from now, you can do that and be reasonably calm that, look, they'll be able to understand what's in there. So there are some other things. If you visit, it's part of your engagement, you actually go somewhere and observe some facilities. If you looked at any contracts, if you talked to and interviewed any people, that should also be documented. What's required is actually detailed analysis of subject entity related and financial information. You need to understand what the company or entity you're is about, any bylaws, whatever, kind of understand the structure, its business environment, and so on. It's based on the revenue rule in 5960, which we saw earlier in the semester, on obtaining understanding of the nature of business and the history of enterprise. So here are some factors: Exhibit 17.3 in Krugman. What do you want to document? Nature, background, and history of any facilities that the company has or an entity has, organizational structure, who is the CEO, who is the vice president, who is the treasurer, who is the board, whatever. What is the management team? Classes of equity ownership, are there any different classes of stocks, restricted stocks, preferred stock, common stock, and so on. And that affects, of course, marketability and the value, nature of products and services, economic environment, right, is the key, affecting your judgments about the future, geographical markets, industry markets, key customers and suppliers. Competition, affects your ability to maintain your margins, business risks, strategy, future plans, governmental regulatory environment. So that's, basically your standard financial statement analysis stuff, which I teach in the financial statement analysis course when we talk about, there's a pyramid of service, you can think of a valuation of it called as a pyramid, right? And the bottom of the pyramid is understanding of the business. And that's how you document. You have to document that you understood the business by considering these factors. Again, going back to Rule 5960, what would you want to discuss? History of business, form organization, restrictions of sale, subject of interest, right? Is this a marketable investment or not? Any subsidiaries and affiliates, ownership and control, who are the owners, who controls it? Is this truly again, it goes to the notion of marketability, product line, subject to industry, competition, and location, right? So this is to give geography that we talked about. Economic data and financial statement analysis, you should discuss the underlying economy. One thing that Krugman says, and I totally agree with, don't just pull the economic report from one of those databases, and just include it. There is this bad practice of just downloading a report from one of those industry databases like IBIS World or Mergent or whatever, and just include it without any sort of criticism, because you don't know necessarily, first of all, and Krugman talks about it in his example critique of the report, whether it's even applicable, whether it's reasonable, right? This is a source of information. You need to critically assess it, discuss it, put it in the context, preferably from more than one source. And why should you rely only on one database? If you can, right? Maybe there's something so niche, there's just only one database that's available, if any. Provide trend and ratio analysis. Again, contextualize it over time across companies. Discuss it. Again, good financial statement analysis should be present. And of course, develop your forecasts. Now, the thing about forecasts, typically the courts, their best preference for a forecast is management's own forecast. Like, so if there are any budgets that management develops, that's like the best forecasting evidence. You as evaluation analysts obviously have to take that kind of critically, maybe adjust it, discuss it. But so any internal data takes precedence over your own external data or your own assessed data. And so if you provide your own forecast, you need to discuss it in the context of any internal data available to you, right? If any. You have to talk about kind of the boilerplate fashion that's okay about evaluation approaches and methods used. So if you're going to use market-based multiples, talk about that, explain in the report what it is, right? Or discounted cash flows, income-based approaches. So there has to be a section, essentially a boilerplate section, explaining methods. And explain why you rely on methods that you did, explain why you didn't use them. Now, obviously, it's a good practice if you read the Krugman chapter to the extent you can use both discounted cash flows, income-based methods, and market-based methods, if at all possible, and reconcile them, right? Kind of, there will always be some discrepancy, and explain why, provide reconciliation of the value on the different methodologies. Any evaluation adjustments, whether marketability discounts or control discounts, have to be disclosed, have to be explained why they're used. Obviously, only if they're allowed in the context of this particular engagements. Remember, certain courts, certain jurisdictions don't allow marketability discounts, right? So we don't put them in. You want to talk about you. You want to talk about what makes you worthwhile deliver this report. So what makes you an expert? What degrees you had, degrees of education, years of education, have you published any evaluation articles or other types of articles, any books, any affinity organizations you belong to, whether it's American Institute of CPAs, whether it's NACVA, National Association Certified Evaluation Analyst, or maybe you have a CFA charter, anything like that, anything that establishes your credibility as an expert, that demonstrates you have the requisite body of knowledge. Have you made any presentations? Have you taught any classes? And so on. What the report has also to contain, just like the audit work papers have to have a representation letter from the clients, you're also making, in this case, representations, which is basically kind of things that, you want the audience to know that you did, right, or assumed. So one is that you didn't, that you made your best judgments about what's in this, and you're truthful in whatever you say in this report. So statements of fact contained in this report are true and correct. That you have limited assumptions, that whatever you're doing is driven by your assumptions, and these are assumptions, this is not the ultimate truth. You don't have any bias or any financial interest, right? Remember, actually, I think it's both Chris Rosenthal and Rob Carter in their presentations that they provide you with, they talk about the fact that you're not actually an advocate for the client most of the time. You are, as an expert, you work for the judge, right? So you cannot be, overtly biased when you provide these reports. You work for the judge, you can have a different opinion, but you ultimately, your goal here is to kind of help judge come to the truth. And so on. So you can talk about, some of the things that you want to represent. But the goal here is to communicate from these representations that you're not a biased person. You're doing this out of your best judgment, that you're not being bought, you're not being forced to do things that you don't want to do, that you're really trying to make your best, express your best reasonable opinion here. So we talked about that, you could provide either detailed report or summary report. The detailed report is obviously more expensive, shouldn't be used to communicate results of calculation engagements, either one. So essentially, sort of, it depends. Ultimately, Krugman says that summary reports are perfectly acceptable. The type of report ultimately depends on how much your client is willing to pay. Detailed reports are obviously much more expensive. Talked about calculation engagement as the type of report that should be used only to communicate the results of a calculation engagement, should not be used to communicate the results of valuation engagement. So what goes typically into calculation reports? So this SSVS1 gives us some ideas. Certain calculations procedures to be performed. maybe you need to calculate the value of the minority interest or something like that specifically. Describe the calculation procedures, describe their purpose, and so on. The estimated value as a calculated expressed as a calculated value, and so on. I think the nice point that Krugman makes is that by producing a thoughtful report that's sophisticated, that's just kind of thorough, you signaling your ability to the market as an expert. So you need to also make sure that you quote authoritative sources. Right? Where do you get this information? So there's a fairly wide valuation literature. If you want to get into this profession, and we talked about, for instance, I rely a lot on Krugman book. I mean, Krugman books is a great, actually, kind of I would say evaluation Bible, right? It's a very thorough piece that you can quote to justify your positions. Larry Pratt has several books that have been traditionally, used quite a bit. Unfortunately, Larry Pratt died fairly recently, and so some of this literature is becoming outdated. And then Krugman gives you examples. There's a Hitchner, a book, Financial Valuation. So if you ever get into this profession, it's good to have a library from which to quote. There's also articles if you can get holds of them. There's various journals. For example, there's a journal called Journal of Forensic Economics. That are authoritative economics journals dealing with valuations issues. They're valuation publications. The bottom line is that you want to give, when you tell a certain story, right? Your story is kind of an opinion, right? But you want to show the audience that you don't pull your opinion out of thin air, that you're actually standing on the ground of the literature, on the foundation of the literature, that it's reasonable in the context of the literature. Then that makes it much more difficult for somebody to criticize you. So what I like about Krugman's chapter is talks about some of the common mistakes that people make in valuations, using their own value, whether, let's say, fair value, market value, investment value. You have to use the right one that's appropriate to the case. How you value, choice of wrong valuation methodology. For example, if there's really no reason why you shouldn't at least attempt to use both market and income approaches, but if you use one not versus the other, you have to have a good ground for why. So, for example, it's kind of clear why sometimes you can only use income approaches, discounted cash flow, because there is no market, so there's no transactions to rely on. Okay, fine, I get that. But the other way around, why not? Because market approaches could be biased, right? We talked about from the beginning of the course, it's very difficult to choose comparable companies. Well, what if you use the wrong market? So market approach, you can always get criticized on the choice of the marketable or comparable, right? So when you use both methods, even if maybe you can argue over a use of a particular comparable. Well, I also use the third methodology, and look, they produce similar results. It's much more convincing to do it that way. And that's what he talks about, not relying on a favored method, right? There's no favorite method. There's all kinds of methods. One could be more advantageous than the other. They're all subject to biases. So therefore, it's better to use more methods and to see if you can come up with some sort of a consensus here. Using methods that contradict each other, using bad market data, right? That's why I try to get data from multiple sources. Obviously, it's the easiest thing to argue, to criticize on the choice of comparables, right? So make sure that whatever comparables you relied on, like they're really as closely aligned with the entity you're evaluating as you can. Discount capitalization rates, right? Discount rates, what discount rates? So don't just use a mechanical discount rate. You have to justify your discount rate, right? And we talked about that. What is the reasonable discount rate in the other chapters? Justification of usage of control and premium and illiquidity discounts and premium. Obviously, don't want to have typographical error. There has to be professionally done report that you want somebody to read. You want the judge to be impressed with and jury, and provide any logical conclusions. Here's an example that Krugman gives of a reconciliation of value across different methods. So you can see, for example, the income approach produced a value of $960,000, and which they relied on 20%. They gave it a weight of 20%. Some other multiples, And in the end of the day, they come up with a value of 4.5. I'm sorry. So it was 4.8 million. I'm looking at the calculated value. They gave it a certain weight, and then added it all up, and it's a weighted average essentially approach. So across different methods, they're all kind of within the ballpark. I mean, they're not relying at all on the adjusted book value liquidation value. So multiples use sort of a weighted average method to come up with $4.5 million, right? So how you choose these weights is up to you. It's a judgment call. It makes a point, don't just use an average. So anyway, so this is kind of like a summary of Trugman chapter on valuation reports. The most important, I would say to me, the biggest value in this chapter is his critique of another valuation reports. And that's why I'm asking you guys to actually do an assignment, criticizing his critique, right? Reviewing his critique. It's very, very valuable. It's a very long, I think it's like 15 pages long criticism of somebody else's report. But in many ways, it's super illustrative in this chapter of what can an opposing expert could latch on. So that's why I see it as so valuable for you to look at. Anyway, I hope this was helpful. Thanks very much for listening. Have a wonderful day. Bye-bye.